Most investors think they understand the wash sale rule until it blindsides them. There are a few traps in here that quietly cost people money every year. So let's unpack what really matters and how to avoid getting burned. My name is Erik Goodge. I help business owners and near retirees reduce taxes and retire with confidence. Let's get into it. Here is the textbook definition of a wash sale rule. A wash sale occurs when you sell or trade stock or securities at a loss and within 30 days before or after the sale, you 1. Buy substantially identical stock or securities, 2. Acquire substantially identical stock or securities in a fully taxable trade, 3. Acquire a contract or option to buy substantially identical stock or securities, or number 4, acquire substantially identical stock or securities in your individual retirement arrangement, or IRA as we most often call it, or Roth IRA. So 30 days before or after the sale of a stock or security. So you might be thinking that's a 60-day window, but that's actually a 61-day window because you have 30 days before the sale, 30 days after the sale, and of course the day of the sale. If this happens, the IRS rules state that you cannot deduct the loss on the sale. The disallowed loss is added to the cost basis of the new stock or securities. The holding period of the investment you sold is added to the holding period of the new investment. So that's a little abstract. Those are the textbook definition and rules. Let's look at some examples to put a little bit more color on this. And we're going to start with a taxable brokerage account. Let's say you buy 10 shares in January for $1 a share. So your entire cost basis is $10, right? You pay $1 per share for 10 shares, $10. Got it. Okay, July 1st, this stock has done horribly. It's down to 1 penny. So you sell all 10 of your shares for 1 penny a share. You've sold them all for collectively 10 cents, right? You had 10 shares, you sell them for a penny a share, you get 10 cents. All right, now July 15th, you're thinking to yourself, there's no way that this stock dropped all the way to a penny. It's due to bounce back. I made a mistake 2 weeks ago when I sold those shares. I'm going to jump back in and buy those shares, and there's still a penny a share. Okay, well, when you sold those shares, you had a $9.90 loss, right? Your total basis when you paid $1 per share for 10 shares was $10. They lost almost all of their value. You sold your shares for a penny a piece for 10 cents. So you had a $9.90 loss. I think that is perfectly understandable and easy to understand. But here is the catch. Since you sold before 30 days after the sale, that loss is considered unrealized. And the loss is going to be added back to the basis of the 10 shares you purchased for a penny. So the tax effect is the same as if you never sold the shares to begin with. Now, once you do sell those shares, you will unlock that basis again. You will be able to take advantage of any loss that remains. But as it stands, you've triggered the wash sale rule and you can no longer deduct that $9.90 loss. Okay, that's a very vanilla, easy to understand example. I don't think many people have a hard time wrapping their head around it, but it gets a little bit trickier than that. So here's another example, and this is an example of a common trap, and I call this the dividend reinvestment trap. Let's say you buy 10 shares in January, and let's say that you've quit dabbling in penny stocks and you pay $10 a share this time. So you buy 10 shares for $10, $100, right? Okay, July 1st, you buy 1 more share via dividend reinvestment for $5. Okay, so let's say that this had a massive dividend yield if you got a $5 dividend, and you immediately reinvested that dividend into the purchase of an additional single share. Now the stock is trading for $5, so your cost basis on that additional share is $5. That makes sense. All right, so you have 11 total shares, and you made that dividend reinvestment purchase on July 1st. Okay. July 15th, you decide to sell all 10 shares of your original 10 shares for $5. So you paid $10 for 10 shares and sold 10 shares for $5 a share. So you have a collective $50 loss. You have a $5 per share loss. You originally paid $10 per share, sold for $5 a share, so you have a $5 per share loss, and since you sold 10 shares, you have a $50 loss. That makes sense. The IRS will say that you have disallowed the loss for one share because you had dividend reinvestment turned on. And this catches a lot of people off guard. They don't realize, especially when you have multiple accounts going on, that if they sell at a loss in one account while another account is quietly accumulating shares in the same or substantially identical security via dividend reinvestment, that disallows those losses. Now, here's something to pay attention to. You purchased one share, so that means there's a disallowed loss for a single share. So now you have one share worth $5. You paid $5 for that share, but your basis is going to be $10 in that share. And the reason the basis is $10 in that share is because you take the $5 of loss that you were not able to realize because you triggered the wash sale rule due to that dividend reinvestment. Recall that you had a $5 loss on that sale, $5 loss per share, that is, on that sale. So you need to take $5 per the number of shares that you bought that triggered the wash sale rule. In this case, it was 1, and add that back to your basis. And since your basis was $5, now it's going to be $10. Okay, so does this mean the wash sale rule fully prevents you from ever realizing the loss? No, that is not the case. This is more of a deferral, not a denial. The IRS is basically saying you can't claim this loss yet because you bought the stock right back. It's as if you never really got rid of the position. You retained exposure to the stock while trying to take the deduction for a loss, and that's not really fair. So we're going to add the loss back to your basis of the shares that you just purchased. That's what we just saw in the dividend reinvestment example. Since you had a $5 per share loss and you purchased another share, which triggered the wash sale rule, we are going to add that $5 per loss back to your basis. And that doesn't mean, though, that you forever lose access to that $5 loss. It just means that when you turn around and sell that one share that triggered the wash sale rule, again, this is the share that you purchased within 30 days before or after you made the losing sale, you won't be able to realize that loss until you turn around and sell that additional share. Okay, now, you might be thinking, well, what if the price of the share increases? Does that mean you never get to realize that loss? Not quite. Since you're increasing the basis of the share that you purchased by the amount of the loss you were not allowed to take, you're effectively getting that loss back. So let's say you purchase in July for $5, you would then, and it goes up to, let's say, $12. Well, your basis was increased to $10, right? Because even though you purchased the stock for $5, we added the $5 loss that you weren't allowed to take. So if the stock increases to $12 and then you turn around and sell, well, then you just have a $2 gain instead of a $7 gain. So you still get the same effect of that loss, which is great. Now let's say that you have many tax lots, which means you've made many purchases over different periods of time, and then you make a wash sale transaction. Which tax lots does the disallowed loss apply to? And I'm going to set up a contrast here to show you what I'm talking about, because it can get a little confusing if you don't see exactly what I'm talking about. The IRS uses a FIFO-based matching rule for wash sales involving multiple tax lots. What does FIFO mean? FIFO stands for first in, first out, and this means your losses are based on your oldest shares. So the first shares to go in or the first shares to go out. So if you have multiple tax lots, you're selling across multiple tax lots, and you have a wash sale, losses are going to be applied to those oldest sales first. Okay, so let's say you buy 50 shares in January at $10 a share. Okay, you got 50 shares, $10 a share, $500. Understood. Then you buy 50 more shares in February. This time it's trading at $8 a share. Okay, that's $400. You've invested $900 total now, and that's your basis. Now, on July 1st, you sell all 100 shares for $7. So you got $700 worth of proceeds from that sale. 50 of your shares will have a loss of $3 per share. That's because you bought your first 50 at $10, you sold at $7, so you have a $3 per share loss. 50 of your shares will have a loss of $1 because you bought 50 of them at $8 and you sold for $7, so $1 per share loss in those 50. So your total loss on 100 shares is $200. That makes sense, right? Okay, all told, you sold for $700 and you paid for $900, you have a $200 loss. That makes sense. Okay, now let's say 2 weeks later on July 15th, you decide that that was a mistake and decide to buy back 100 shares at $7 a share. You've decided that you should have never done that sale. Okay, well, you've clearly triggered the wash sale rule, right? Because just 2 weeks ago, you sold all your shares when you had a $200 loss. You turned around and bought them all back, so you're not going to be able to take that $200 loss. The IRS will say that you never realized your $200 loss, so they will take your $200 loss, they will add it back to your newly established $700 base. You have 100 shares that you purchased at $7 a share. And so now, instead of $700, your new basis is $900, and you're right back where you started, right? No, there's no difference. Now, here is the contrast to highlight why the FIFO matching rule is important. Let's say instead of buying 100 shares back on July 15th, you instead buy 10 shares back. This will still trigger the wash sale rule, but now instead of the entire loss being disallowed, only the loss on 10 shares will be disallowed. This makes sense, right? The offending transaction, so to speak, was the purchase of 10 shares. It wasn't the purchase of 100 shares. So we're going to disallow the loss on 10 shares. But you have multiple tax lots. So which 10 shares should we disallow the losses on? Remember, you had a loss of $200. You originally paid $900. You sold for $700, so you had a $200 loss. You bought 50 shares in January at $10 a share. So the loss on those shares is $3 a share. 10 minus 7, $3 a share. If we disallowed losses on 10 of your January shares, then you'd have a total of $30 in disallowed losses, because $3 per share, 10 shares is $30. You also bought 50 shares in February at $8 a share. So their loss is $1 a share. And if we disallowed losses on 10 of these shares, you would only have $10 worth disallowed losses, which is way better, right? It's like, I want to assign my disallowed losses to the February shares, not the January shares, right? Well, you can't do that, especially if you sold all those shares on the same day. What's going to happen is that you'll have the loss applied to your oldest shares. Those are the losses that'll be disallowed, which in this case is the January shares. So your total disallowed losses is $30 or $3 per share. So the IRS will reduce your losses that you can realize from $200 to $170. And you bought back 10 shares, right, at $7 a share. So your basis should be $70, but the disallowed basis, that $30, is going to be added to your new basis of $70. So your new basis is actually $100 or $10 a share, the same price you paid in January. It's as if you never sold them. Okay. What happens if the wash sale is the result of an IRA purchase? There's something to understand about the wash sale rule. It applies to all of your accounts, and not just all of your accounts, but all of your spouse's accounts and all of the accounts of any companies or entities that you own. So it's not as if you can sell shares in a taxable account to realize a loss and purchase them in an IRA or a Roth so that you retain exposure while getting the tax break for the loss. And actually, the circumstances are pretty bad in this case. Let's go back to our original example of buying 10 shares in January for $10 a share. If you bought 10 shares in January in a taxable brokerage account, and then on July 1st, you decided to sell those shares for, let's say, $1. Okay, well, you have a $90 loss, right? That makes sense. You paid $10 a share, 10 shares, that was $100. That's what your basis was. You sold them for $1 a share, which means you have $10, so you have a $90 loss. Great. Well, what if you turn around either that day or within 30 days in your IRA and you purchase 10 shares again at $1 a share? Okay. Well, now you are going to disallow the losses on 10 shares. And just like we explained, those losses are going to be applied to the losses. In this case, there's only one tax loss, so it actually doesn't really matter. It's going to be applied to the losses on the shares in January. But there's a catch, because in IRAs don't have basis. So the IRS can't take your $90 loss or $9 per share loss and add it to the basis of your IRA transaction. So you purchase 10 shares for $1 a share. Ordinarily, what we would do is we would take the $9 per share loss and add that back to your basis, so that effectively your basis is now $10 a share again, which just undoes the loss, right? We can't do that in IRAs because there is no basis. So that loss is gone forever. You have destroyed that loss. This is something that catches people off guard all the time. This applies to IRAs and Roth IRAs. It can apply in instances of, again, dividend reinvestment purchases that were totally unintended. You might not even have been trying to game the system, but that is the result. The loss will be forever disallowed, and there's nothing you can do about it. So avoid that. What if you sell a stock for a loss and your spouse purchases the exact same stock 30 days before or after you sold your stock? We have a aggregation sort of rule when we're thinking about this. So the IRS, whether you file married filing jointly or married filing separately, whether the accounts are titled in both your names or in separate names, it doesn't matter. Whether the accounts are different kinds of accounts, that doesn't matter. If your spouse buys a security that you've sold for a loss on 30 days on either side of that loss sale, you are going to trigger the wash sale rule. And I don't think anybody would try to do this to game the system, because it's very clearly against the rules, and I think most people know it's against the rules. But I can imagine situations where perhaps there's different managers, investment managers on the accounts, or maybe the communication is lacking and the spouses just didn't know. Or maybe one spouse has a stock set up with dividend reinvestment, the other spouse simply doesn't know. All of these things can trigger the wash sale rule. So communication in that situation is important. So that was an overview of the wash sale rule. I am willing to bet that most people didn't know about all of those situations. In particular, a lot of people are caught off guard by the IRA loss destruction, so to speak. A lot of people forget about their dividend reinvestment transactions. And hey, look, you might be thinking, well, dividend reinvestment, we're disallowing the loss on the number of shares you purchased in the offending transaction, right? If I purchase one share, that triggers the wash sale rule. We're disallowing the losses on one share, and that might not be a big deal. But if you have a substantial account, and you have that account, or a substantial position rather, within an account, and you have it set on dividend reinvestment, it could be the case that that dividend is pretty sizable, and the number of shares, the value of the stock that is purchased with each dividend is pretty substantial. And especially if you're trying to sell for tax purposes, to do some tax planning, this can just throw a big monkey wrench in things. So it's definitely something to be aware of. These are the rules, the wash sale rules. My name is Erik Goodge. I help business owners and near retirees reduce their taxes and retire with confidence. And thank you for watching.